good afternoon. You're watching Closing Trades on 80 Now. I'm Anisha Jain. With me is Aisha Faridi. For now, the Nifty has scaled past that mark of 18,200 on the Nifty. And it's earnings galore. You have HDFC Limited reporting its numbers, which look better than expectation. The number has come in at around 4,300 something crore. We were expecting a number of around 2,800 crores. So there's a big beat as far as HDFC is concerned. Of course, the provisioning is a bit higher than what we were working with. We were expecting that provisioning will be around 200, 300 thereabouts. The number is actually higher at around 450 crore thereabouts when it comes to the provisioning figure. So the net profit of 4,430 is better than expectation. So a beat coming in for HDFC Limited. For NII and AUM growth, of course, we'll have to wait by to get more details from the press release. But the expectation was that the asset under management will jump up by around 12% year on year, and the net interest margin was also expected to remain healthy. The stock is reacting quite positively. We have a gain of almost 2% there, but can't say the same about Dabur because the first look on the numbers looks a bit disappointing. The profitability came in at 300 crores. We were working with a number of around 350, 360 crore on the bottom line. So that's a bit of a miss. Though the top line looks in line with expectation around 2,680 crore on Dabur. So it looks like it's going to be an operational miss for Dabur. But for HDFC, not much to complain because the solid growth when it comes to the profitability. A big beat, we'll have to wait and see if there is any one-off, etc. But for now, the numbers look healthy as far as HDFC Limited is concerned.
Yeah, and you can see the stock price reaction as well. HDFC is at the high point of the day. It's a 2.25% bump up that you're seeing. But on the other hand, it's a bit of a nosedive actually for Dabur, which was holding steady up until now. But it seems like the operational numbers, at least on the first glance, have missed street estimates, and which is why you're seeing that big crack emerge on the stock. But let's first analyze HDFC's performance. Rahul Malani joins in on the phone line. Rahul, hi, afternoon. A thumbs up, I guess, for HDFC. No complaints.
So good afternoon. Yes, on the operational front, it has given a beat of around 5. At core operating profitability, it has given a beat of around 5% versus consensus and our estimates, which has been mainly led by the net interest income growth. So net interest income is also above our consensus and estimates by around 4%. So definitely there would have been some margin improvement during the quarters. And if we look at that, provision cost is marginally higher than our estimates by around 40-50 crores. But despite that, due to other income, the PAT is higher by around 10% versus our estimates and consensus.
We don't have the numbers of NII from the press release yet, but if you calculate it, it looks like the number is closer to 5,250 crore. Our expectation was around 5,000 crores. Rahul, your take on the NII figure, because it looks like it's up 20% on a year-on-year basis. And also, do you believe the numbers were factored into the price, or would this call for a bit of re-rating or adjustment of EPS estimates?
So basically, the NII, what our internal calculations suggest that it is at 5,300 crores, and it is up by 16% and sequentially on 10% on quarter-on-quarter basis. So definitely, it looks from the numbers that there would have been certainly margin improvement during the quarter. AUM number is not out, so I cannot currently calculate the margins at present. So overall, we believe that the numbers are healthy in terms of outlook. If we look at the mortgage segment, growth has been moderating in from last one quarter, and it has been accorded rightly with all the banks and NBFCs in the past conference calls. So, but there would be certain commentary related to the outlook will be important. And from here on, if we look at the interest rate cycle is also closer to its peak, so which could act as a tailwind. So there are partial headwinds and partial tailwinds also. So cumulatively, we have to look at the first management commentary, and then we can decide upon it.
We'll wait back for more commentary to come by from the press release of HDFC Limited. Rahul, we'll let you go on that note. Thank you so much for joining in. But the numbers for Dabur don't look that pretty. As I was pointing out, it looks like a miss on the bottom line. 300 crore is the profit figure versus expectation of 350 crore. And that's stemming from the operational miss because the margin has come in much lower than what Street was expecting. Last year, the margin profile was close to 18%. This time around, the margins have dwindled to the level of around 15.3%. And that compares with our own expectation of around 16.5%. So there's a big miss when it comes to the operational performance as far as Dabur is concerned. The top line looks broadly in line with expectation, but not a big beat coming. So it's an operational miss coming in for Dabur, because even if I look at the segment-wide performance on a standalone basis, It's the consumer care business which has shown a decline on a sequential basis. The food business has done all right, but it's the consumer care business which is actually the pain point, and perhaps that's the reason we're seeing a bit of a miss coming in from Dabur, and the stock, of course, reacting negatively on that as well, down about 2%. So the consumer care segment on a consolidated basis is flat year on year at around 2,096 crores, though on a quarter-on-quarter basis from 2,600 crore levels, it's down to around 2,000 crore rupees. So we'll have to wait by and see what really pans out, but looks like an operational miss for Dabur, and that's why the stock has tumbled quite a bit. We'll wait by and get Vinny to analyze those details for us as to how the volume has stacked up, what are the other internals to watch out for. But for now, it's a thumbs up coming in for HDFC Limited and a thumbs down coming in for Dabur as well. But let's move on and welcome perhaps the technical experts on the show to make sense of what the market texture is looking like, because 18,200 is there on the cards. Nuresh, we'll analyze the numbers of HDFC Limited as well as Dabur in a bit, but first up your take at the index level itself. Where do we go from here on?
So today's move has been much higher than expected. We've crossed about the 18,200 mark, which opens up a trend towards 18,600 also. And now 18,000 becomes a base instead of 17,800. So a strong move today. And one thing which can actually drive the markets is HDFC Bank and HDFC Limited. So HDFC Bank all-time highs is around 1725, and today also we came very close to that. And this is a mark which has been tested almost 4 times over the last couple of years. And once this breaks out, this creates a 10% upside for HDFC Bank. And we see a lot of correlation in terms of movement with HDFC Limited as well. So if this move takes up, that is like 15%, 16% of the index, which can drive the Nifty as well as the Bank Nifty. So overall, HDFC Bank could decide the further momentum. So continue to have a hold view on the Nifty and look towards the 18,000 as the base going forward.
Right. Okay, I'm just waiting to see what the volume picture would be for Dabur and whether this is an RMC cost-led damage that they've actually seen in the quarter gone by, or there's been a big slowdown that you've seen in the rural economy, which has perhaps impacted Dabur's performance. The margins, of course, have taken a deep dive here, 15.3% as opposed to 18% in the same quarter last year. We have, I think, Sandeep Sabharwal as well joining on the show. So let's talk to him a little bit about that. Sandeep, while we're still trying to grapple our head around this margin miss from Dabur, what do you think this could be regarding?
I think all of us know consumer demand has been extremely subdued. So most of the companies have been trying to push volumes into the markets. So my guess is there could have been higher promotion and advertisement expenses, which could have led to this miss, because the company would have tried to push volumes. Obviously, price hikes are no longer happening. So I think because raw material prices as it is have been moderating. So companies will try to grow through volumes only. And those could be the main reasons.
Okay, no, it doesn't look like the advertisement cost, because it's flat year on year at 150 crores. My guess is it's the cost of materials only. Maybe they were sitting at higher inventory or something, because the cost of material consumed has jumped up to 1,450 crores versus 1,300 crore last year. So that seemed to be a bit of a niggling worry at this point of time for Dabur. But Sandeep, your take as far as HDFC Limited is concerned as well. The twins continue to surprise on the upside when it comes to the performance, and given their scale, definitely deserves a thumbs up.
Yeah, HDFC performance this quarter was expected to be strong. Now the challenge always is the merger process and what it does to the margins, because especially for bulk borrowers like HDFC, where the repricing of loans happens faster, they benefit in the initial periods and then they would take a hit. But overall, in a positive foreign fund flow scenario, which I expect to last, because I think emerging market flows will remain strong, HDFC and HDFC Bank will get their fair share and should continue to do well.
Not a neck-and-neck comparison by any means, but Britannia is due to report its numbers tomorrow. Sandeep, would they also get hit by the rural slowdown, or do you think that's a completely different story and more of an urban consumption, so you're not likely to see the same kind of margin that you've seen from a Dabur?
Britannia has held up its with a lot of headwinds related to uptake in wheat prices, uptake in milk prices, etc. till the last quarter. they had some hedges also going for them, which helped them initially. Now, milk prices, all of us know, have been boiled. So what that does to their performance at a time when consumer demand is subdued, and they would also have potentially had to push sales into the market, is something we need to see. But overall, for consumer good companies, the fourth quarter results were expected to be challenging, and for some it's been more challenging, and for others it's been less challenging. So I think that's the only difference.
Might be expected to be challenging, but at least Bajaj Consumer has managed to beat the expectations and has reported a number which is overall beat versus the expectation, because the top line growth came in at 14%. There was volume growth of almost 10%. The margins also have actually managed to improve by 80 basis points, and that compares with just the numbers that we got for Dabur, wherein there was a margin miss. Let's try and understand with the management as to what's working well for them. We have with us Mr. Jaideep Nandi, the MD at Bajaj Consumer Care, joining us on the show. Mr. Nandi, hi. Thank you so much for making time and speaking with us. I wanted to begin by discussing the margin performance itself, because you managed to improve the margin by 80 basis points. What were the levers that aided the expansion, and what's the outlook going forward for margins?
Yeah, I think what has happened is clearly for the last few quarters, our margins were under pressure because of our two key raw materials, LLP and RMO, which were really high. So last quarter, both LLP and RMO prices have softened. That has clearly aided the gross margins. Plus, our product profile has also started to slowly improve. We have been focusing on our premium portfolio, not only beyond ADH, also in some of the other personal care products. Very small still, but on that. So that have also started getting traction. So put together, both have started yielding results.
Going forward, is there more upside to the margins? It was what, 16.7% as the exit rate for FY24. What could be the overall number for the year?
See, the quarter four EBITDA ended at 17.9% for our standalone sales. And we think that is where it will remain about range bound for the next year. Our marketing expense, we had elevated it last year to ensure that our new products are supported well. Plus, we had gone a little higher on our digital count while maintaining our conventional media. So marketing expense is something that we'll continue to remain invested in. So we expect that with LLP and RMO, both the key raw materials as well as our packing material remaining more or less range bound, we expect that EBITDA margin should follow mirror what we have been seeing in quarter four in the current and the near future.
Okay, so the margin expected to remain around the current level in the coming year as well. Wanted to get your take regarding the marketing spend that you just pointed out too. You had earlier indicated it will rise up to the level of 30%. What's the timeline for that, and a color on how the international markets are doing?
Marketing expense, we had maintained that we'll keep it about 18 to 20%, and that has gone slightly down at about 17%, mainly because we have kept our overall spends of marketing about the same, about 42 crore rupees is what we are spending in marketing in ASP basically for the quarter. That is what has remained. With the sales growth, basically the percentage has dropped a bit. So marketing spends will continue to remain at these levels. As I said, it will be split between what we spend on almond drops as well as the new portfolio. And it is also being split now with a higher contribution of the digital spends in media to support our new brands. So this is on one side. As far as the international business is concerned, that has been the focus for the company, because that's where we have not been really present in the past. So this year we saw a 56% growth as far as the overall year is concerned. Quarter was even better, but these are obviously on low basis. And we have focused on key geographies. Middle East is one of the geographies we are focusing on. Bangladesh is a big market for us, and some of the rest of the world markets, so one or two markets for export, we feel we are zeroing in where we see that Indian diaspora, and especially the products that we have in our portfolio, have good traction. So we are focusing in few of these key markets, and we expect international to be a big growth driver for us in the next few years as well.
Jaideep, help us understand what really is the reality on ground when it comes to rural India, because clearly looking at Dabur's numbers, it seems like rural slowdown could be a reality. You perhaps would have a better handle on it.
So if you look at That's absolutely correct. While there is a lot of news about rural markets improving, yes, they are recovering from no question. But given that where they had slumped, they have not yet recovered to the normal levels. Even if last quarter to look at, the rural markets were down. Even if you look at the overall hair oils numbers that Nielsen is reporting, the last quarter rural numbers were still negative, and negative by quite a bit. In fact, mid-single digit negative. It has improved from double-digit negative to mid-single-digit negative, but they are still negative. While hair oils have recovered and gone into just about positive territory, and urban has rebounded sharply and is now about mid-single-digit percent. As far as we are concerned, we mirror similar results, except that our urban growth rates has been in high teens. So urban has been a big focus area for us. Retailing initiatives we have been taking all across. So urban has given us good growth in the general trade business as well as modern trade e-commerce. Both of them have performed well. So that has obviously aided our growth rates as well, because urban is doing well and our modern trade e-commerce as well as urban retail has done well. Rural, we have recovered, but given the pressures that we see in rural, we think that it will still take about a quarter or two to come back to its normalcy. But clear signs of recovery in rural.
Just before we let you go, you are expecting the double-digit growth to continue into FY24 as well, right? Will it largely be volume-led or price-led?
So price increases, in fact, while last year we have not been able to offset most of the raw material prices that had gone up, we have not been able to offset it by price increases because the demand situation has not yet improved. While now the demand situation is improving, we are seeing the raw material prices softening. So it may not warrant a price increase at this stage. So whatever growth rate you will see in realistic terms will be volume led. I mean, the value has to be driven by volume growth itself. Unless there is a structural change in the market, and if raw material prices were to go in some specific direction, south or north, then it will be a different thing. But at this stage, as it looks, volume will mirror more or less what value growth is.
Mr. Nandi, we let you go on that note. Thank you so much for joining us with that quick take on the numbers. Just wanted to quickly flag off the stock of Manappuram Finance as well, because that's spiking up as we speak. Looks like there is a clarification that the company has made with respect to the ED rates that were happening. We'll track that when we come back, but slipping into a very short break at the moment. Welcome back. Well, there has been a definite recovery for the market, 160 points higher as far as the day's low is concerned. So 18,222 is where we're at. Sandeep, wanted your take regarding some of the other spaces which have been buzzing in. Tire, of course, is one space which has seen good results come by from MRF. The fact that the crude prices have declined materially as well. Do you think that going forward, the tire stocks are likely to continue the uptrend?
The possibility is very high, because of the fact that there's pricing discipline in the market, and to that extent, people are not the tire companies are not cutting prices and increasing competition against each other in markets. Imports are subdued, and raw material price benefits will continue going forward also. So I think since from the inventory or the costing of the current quarter, the next two quarters will be even cheaper. So I think profitability could get further boosted. So I think overall the output will be strong.
Right, just looking at a couple of other buzzers, and Chola Finance, of course, has moved up quite significantly. There's M&M Finance, which is up 5.5%. ABB has seen a very strong show. LIC Housing, Birla Soft, etc. are some of your other performers. Let's see what IT is up to and whether that's seen any resurrection. Actually, it's not looking all that bad. I mean, they're not the leaders in this market for sure, but at TCS, Infosys, all of them are holding up indeed. Sandeep, time's come, you think, to start nibbling into IT or not quite?
It's tough to say because overall market outlook is positive, but then outlook for IT companies actually continues to deteriorate. And in a scenario where the US dollar is also looking to enter into a more of a declining cycle, we could also have a situation where the rupee also does not benefit them in terms of getting margins. So I think it's tough because it's such a huge index component that if the overall markets do well, they won't really fall. But I don't see big upsides.
What about ABB though, Sandeep? I mean, it's been a great quarter for them, beat on all counts. The order inflows are looking extremely robust. Would you not say that for the entire cap goods manufacturing story, the best could have been behind us? Or you think still there's opportunity to buy into these names?
No, I think there's a huge capex cycle on. It's only improving, and to that extent, calling a top at a time where we are just 1 year or 2 years into a big cycle might not be the right idea. But then stocks obviously run ahead of fundamentals, so many stocks have run up. So people will not obviously get the same kind of returns as the profit increases in these stocks. But still, these companies should be able to outperform the overall markets.
We spoke with the management earlier in the day wherein they maintained that at least 10% plus margin is something that is going to be sustainable and that the order inflow momentum continues to be strong. Listen in.
In terms of the market formation, we still see the same robustness as we have been experiencing in last few quarters, and we have no reason to believe that this kind of momentum in the market continues. I think as far as the quarter to quarter concern, the order strength, I think that keeps varying because the different customers have a different cycle of placing those orders. So we will see how quarter two plays out. As far as quarter one was concerned, I think we are quite pleased with it.
Yeah, I think the order backlogs have a strong margins as what we see at this point of time. And we, as I said earlier, our target is to keep consistent delivery of 10% at the bottom line quarter on quarter. And I think as a first step in this year, would like to look at credibility every quarterly delivery. So I think the order backlog support that particular view.
The take coming in from the ABB management, they spoke with us earlier this morning. Financials, they are the ones which are actually charging ahead, led of course by the smaller ones like Muthoot, Chola Finance, etc. But M&M Finance as well scaling up higher, L&T Finance looking good, Bajaj Finance in pole position about 3% is the kind of move that stock is seeing. And then, of course, HDFC continues to react to its earnings, still going strong as we speak. Bajaj Finserv, Shriram Finance, these are all names which are looking pretty robust in today's market as we speak right now. But Kunal, just purely on the trends of Nifty Bank individually, what do you foresee?
So I think it's still very strong, Aisha, because, day after day, in fact, session after session, what we are actually seeing is the move trickling into the different names in the banking names. So I think the move started off with the likes of Canara Bank and Kotak Bank, which actually started to show signs of bottom out first. ICICI Bank led the charge in the mid phases, where the stock came back about the 900 levels. Then you have SBI, which I think led the beaten ahead, moved up about the 570 plus mark. And today it's a clear outperformer that HDFC Bank has managed to just outclass many of the other large cap private sector banking names. And the stock is now in very touching distance of breaking past about the previous lifetime high levels. So the strength which is trickling to the other banking stocks, that makes the move more formidable. So even if we see 100 point, 200 point uptick on the banking index, what matters is that whether the large cap stocks they tend to participate, or whether the move is more euphoric and more centered towards the mid caps and the small cap names or the high beta pockets. So till the time the move is towards the large cap names, like what we've seen today, I think the move could sustain. Would expect the bank Nifty to now possibly scale past about the previous lifetime high levels, and HDFC Bank to continue to lead the charge from the front.
Wow, new life highs coming in for Bank Nifty. That's something that is definitely quite interesting, and how the market texture and sentiment has changed in the last 15 days itself is something to watch out for. Sandeep, I know you have not been too bullish about the entire insurance space, but today General Insurance Company, New India Assurance, they're all up around 15 to 20%. Anything that you would want to talk about when it comes to the entire insurance sector?
No, nothing. It's just that the rising tide lifts all boats. So all of us have to remember that.
Okay, any words from you, Naresh, regarding the chart checks for GIC as well as New India Assurance?
So they both tend to make single day moves. So it is difficult to take a call out here, because this is not the first time they've made a similar move. So say just a few months back also we saw a similar move wherein the stock moved up for a day. Then we say moved up for 3-4 sessions. We saw a move from 150 all the way to 200 and then flopped back to 130 levels. So out here seems a little speculative, and it's difficult to actually now get in after a 10-15% move. The longer term trend is still weak. Overall, I say even after crossing 200 is the where the longer term trend changes. So that is still far away. So would not punt out here. Wait it out, let it more stabilize after this move. Then maybe we'll have a relook.
We'll let Sandeep Sabharwal go on that note. Sandeep, good to chat with you as always. We'll see you again tomorrow morning. But tire stocks, that's another cluster which is actually holding a buzz. Is it the crude sensitivity that's lifting these stocks up, or is it once again rising tide lifting it all kind of phenomena playing out? Shrishti is here with more analytics. Shrishti?
Well, yes, all these tire stocks are running quite fast since a couple of days. And if we know, there are two big triggers for this one. Firstly is the fall in the crude oil prices, wherein crude oil is sitting at a 5-week low, trading way below at $75 per barrel mark in the international markets. And that's a very positive thing for all these tire companies, because the 40% of their RM basket is for the crude oil derivatives, wherein from the likes of synthetic rubber, carbon black, and all these chemical prices, they have cooled off from their earlier peaks. But given the fact that the crude oil prices have also eased further, then that's a positive read-through for all of these tire companies, because crude oil derivatives make 40% of their overall RM basket. But the other trigger for all of these tire companies, because MRF has come up with a great set of numbers this time around, so the expectation is building up that all other tire companies can also surprise on the positive front, because for MRF this time around it was a beat on all the parameters, and especially the margins of the company, because this time around their gross margins led to a 8-quarter high EBITDA margin of 14.7%. And even that, if we look at their RM cost as a percentage of sales, so on a YOY as well as on a quarter-on-quarter basis, that did fell from 67.9% to 63%. So that's the positive read-through for all of these tire companies, why these counters are buzzing. And even today, CEAT numbers are still awaited, where we are expecting a gross margin expansion as well.
Right. HDFC, the numbers are out. Let's take it across to Vamakshi and find out if she has any newer data to analyze for us. Vamakshi?
Well, absolutely. When we look at the numbers that have come in from HDFC Limited, a strong beat as far as the NII and PAT is concerned. We were expecting provisions to decline on a sequential basis, but provisions have come in much higher than what we were expecting. But the AUM is more or less in line with what we were expecting. Now, the net interest income has come in at 5,321 crores, an uptick of almost 16% on a year-on-year basis, much higher than 5,000 crores of the net interest income that we were expecting. PAT has been reported at 4,425 crores, an uptick of 20% year-on-year, while provisions have come in at 438 crores, an uptick of almost 18% on a sequential basis. The AUMs for the company stands at 7,23,988 crores, and that is an uptick of almost 11% on a year-on-year basis. Now, we were expecting a growth of around 12% as far as AUM was concerned, but nevertheless, AUM is more or less in line with the estimates. Now, when we talk about the AUM, the growth in the individual loan book was around 7% on a year-on-year basis. Let's talk about NIMs. They stand at nearly 3.6% versus 3.5% on a quarter-on-quarter basis. So a 10 basis points uptick as far as NIMs are concerned. The asset quality has also seen a significant improvement. The gross NPL has come down from 1.49% to 1.18% on a sequential basis. The board has also declared an interim dividend of 44 per equity share. And we also have a few management comments coming in the press release, and the management is highlighting that the inherent demand for home loan is continuing to remain strong. Growth in the home loan segment was seen predominantly in the mid-income as well as the high-end properties. In March 2023, in fact, the company says that they recorded the highest ever monthly individual disbursements. So that was the overall take on HDFC Limited. We will be definitely watching out for the Concord, but as of now, the results are stronger than what we were penciling in.
It's already reflecting in the stock price. Let's now take it across to our chartists and find out what are their closing strategies. Kunal, on your list?
So there'll be, one of the stock which I've been, advising earlier, HDFC Bank. That's a stock which looks attractive, and I think at this break of 1700 mark, that's a closing, stock which I would look to, buy as well as recommend to my clients.
Right, Naresh, your closing ideas?
So that would be a buy on Container Corporation. The stock corrected from 800 all the way down to 570. Last 3 months range has been taken out today about 630 levels. Expecting a move towards 700 in the short term.
Okay, and Anisha, while you and I are not going to do anything and straight after work go back home, Aishwarya has been the lucky one.
I know.
Who is going to attend the Backstreet Boys concert. And I'm sure you've also been a fan back in the day.
I know, and I'm so jealous right now because I tried really hard to get those tickets and I couldn't. So Aishwarya, I mean, lucky you. So tell us what the energy is like at the ground at the moment. Feels like 90s are back. Backstreet's back, all right.
That's right. That's right. Although millennials who Backstreet Boys was founded in 1993, Backstreet Boys are still music to the ears of most millennials, I believe. Even I am a millennial, and I certainly love Backstreet Boys. But the mood right now here is that we saw almost like 50 security volunteers lined up here. FM being inside is being readied at this point. Although this is the Silver Gate. A lot of crowds will be lining up here. Just a bunch of people have come here. The security has told us that almost 14,000 people are going to be expected this evening. And there are two zones. One is the everybody zone and the other is I Want It That Way, named after their very, their mega hit songs. And right now here, there are few people lined up. Few people have been waiting here since 8:30 a.m. and there's a band of 5 people who love Backstreet Boys, and we'll speak to one of them and get to know why they're dressed up in white this evening. Hey, hi guys. So, these guys have flown down all the way from Calcutta. They're a band of 5 people, and they, apart from being Backstreet Boys fanboys, they also have their own band. They do their originals, and they've met Backstreet Boys back in Singapore as well. So, tell us, what was it like, and who was your favorite among the pack of 5?
Well, we did actually have the experience, me and my brother. This is my brother Faizan, and this is Kamran. So we had the pleasure of meeting the Backstreet Boys in person, and when they got to know that we have a boy band in India, so we sang together at the backstage, and we shared a song with them. And they're all very nice, but Kevin had that brotherly vibe, and he came us and he hugged and, hey brother, nice to see you, as if like he's known us for so many years. So it was very nice. Kevin is like really, really brotherly. Like you see him and you get that big brother vibe.
How much did you get your ticket for here in the silver side?
I think we paid 9,000 per ticket with the tax or without tax. I don't remember, but yeah, 9,000 I think.
All the best and have fun. And she has been standing here since morning. What's her name?
Ishita.
Okay, Ishita has been standing since morning and she's got offers for her ticket. And what was the highest bid you got?
Somebody wants to buy my ticket for three times the price. Yeah. And I said, I'm not selling it. I've been here since 9:30 in the morning. I was the first one here. And I'm really excited to be here because the last time they were in India, the ticket prices were half my salary. I just started working. So now finally I'm in a place where I can buy the most expensive ticket and still have this great experience with them. So of course I'm going to be here front and center with my new friends, everyone on the line. And I'm sure it's going to be a great experience.
Well, it costed her 8,000 back then, and even today it's 8,000 for her. So she's definitely going to have a great time. What's your name and how excited you are?
I'm very excited, and we are from Kolkata. That's Flavian. He's got the T-shirt on, and we've come all the way from Calcutta. We love the boy bands because they were a big part of our growing up, and we just want to thank them for giving us such a great childhood. So we are like super excited. And we're very happy to be here.
Well, thank you very much.
Well, all we can say is, Aishwarya, enjoy it on our behalf. But HDFC, back to number crunching. Let's hear out what KK Mistry have to say after a great performance from them.
1,22,421 crores. As mentioned in an earlier calls, construction finance loans, unlike lease rental discounting loans, have a longer disbursement period as they are disbursed based on progress of construction and after the developer has brought in his equity. Further, over the last few quarters, we have seen some scheduled repayment of earlier facilities and resolution of some stressed assets. We have also on maturity run down exposures in the loan book to ensure compliance with HDFC Bank's norms in view of the impending merger. Such loans aggregated to around rupees 18,000 crores. The total assets under management as of March 31st, 2023 amounted to rupees 7,23,988 crores as compared to rupees 6,53,902 crores in the previous year, a growth of 11%. If no loans had been sold during the preceding 12 months, then the growth in the total loan book would have been 16%. Prepayment on retail loans amounted to 11.3% of the opening loan book. The average size of individual loans for the year ended March 31st, 2023 stood at rupees 36.2 lakhs as compared to rupees 33.1 lakh in FY 2022. The contribution in value terms from customers with an annual family income of rupees 18 lakhs or more has increased during the year to 53% from 45% during the corresponding period in the previous year. During the year ended March 31, 2023, 23% of home loans approved in terms of number of customers and 9% in value terms were to customers from the economically weaker section and the lower income group. The average home loan to customers in the economically weaker segment amounted to rupees 10.7 lakhs and to customers in the lower income group segment amounted to rupees 19.4 lakhs. If we break up the loan book outstanding as of March 31st, 2023 on an AUM basis into different categories, then individual loans constituted 83% of the total loan book as compared to 79% in the previous year.
Market closing trades right here in 18 hour looking extremely robust. In fact, now we've climbed up above that 18,250 mark as well. And Dabur has been, though, reacting to its numbers. While it was sure a positive set from HDFC, it's not quite the case with Dabur. Let me take it across to Vinny and find out why this massive margin miss. Vinny?
So absolutely, just margin was a miss, profitability was a miss, revenue was the only thing that was in line. Now, when you talk about the profitability of the company, we're seeing a bit of a subdued performance there. Why? There are two factors. One, the Badshah Masala acquisition which was there. Now that has seen a bit of a amortization cost that comes in there, that is of 22 crores, as well as there's a one-off of around 85 crores which is in terms of impairment of goodwill of one of its wholly owned subsidiaries as well. Now other than that, margins, sharp contraction of around 250 to 300 basis point in terms of margins, only at 15.2% is what the margins came in at. Volume growth also single digit, low single digit was what we were expecting as well, and volume growth has come in at 1%. Management commentary clearly highlighting in terms of the consumers have been downtrading. They're going for affordable packs. They're going for low unit price products. Surely that means they're more price sensitive, and that is the impact that we see coming in terms of all the performances of the company as well, in terms of volume growth also leading to a lower volume growth as well. Demand slowdown is also clearly seen by the company, especially they're saying it's more accentuated in the rural markets, and that is what is leading to a negative mix for the company as well. Other than that, when you look at it in terms of the foods and beverage segment, that has seen a strong growth coming in. Juices and fruit drinks have gained market share. Even Chyawanprash, they managed to gain market share. But health supplements, there was a very high base last time. Last couple of years, we've seen a high base in Q4 FY22 and Q4 FY21 as well because of the COVID situation that was going on. So this time around, we're seeing a decline in terms of the growth in health supplements, that is down by 3.3%. So all in all, when you look at Dabur's numbers, margin was a miss and profitability was below expectations. Only revenue is what came in line with what we were expecting.
Vinny, for putting that into perspective, but let's welcome on board Anand Tandon as well to talk to us about the market. Anand, a sudden spike as far as the overall market is concerned, 18,260, and now the Bank Nifty is just 400, 500 points away from the life high levels, and ditto for Nifty, not too far away from the life high levels that we have seen. Do you expect them to come real soon?
I didn't get the question. Did you say you expect them to go to higher levels in this?
Yes. Are we expecting record high levels soon on Nifty and Bank Nifty?
Well, obviously they will come sometime or the other. I don't know how quickly or how slowly. The incremental news flow has been reasonably decent, at least in India. And internationally, of course, it continues to remain reasonably negative. So from an opportunistic point of view, I would argue that the Indian market is in a a reasonable shape, slightly expensive again, but and on a relative basis again compared to many of the regional markets is also looking a little expensive. But the sectors that you mentioned, for example, the banking and finance sector, the earnings growth is likely to remain very strong for the next 6 quarters. And even though I would argue that the margins may have peaked out a bit, I don't think that there is any danger of the earnings slowing off, at least for the current year. So I would expect to see continued upside there.
And a lot of stocks are actually sitting at all-time high levels, whether it's HDFC Bank, which is perched at that 17,030 mark, ABB sitting high by around 6%, and Chola Finance too is up around 7%. But Anand, specifically when it comes to the FMCG stocks, the earnings season has been quite mixed, right? Nestle reported great set of numbers, HUL was a bit tepid, Bajaj Consumer a big beat coming in, whereas Dabur has again disappointed. How should one approach the FMCG space now?
So, FMCG, the only sector that is worth where you can take a kind of contra view is the fact that the rural markets will pick up. As you just mentioned right now, Bajaj has not seen Dabur hasn't seen a great growth in the rural area. And so far that has been the story across the board. So the bet one is really taking is that will join the party. And to the extent that suppose it lower trading down of products will happen, mass market products will start to do slightly better in terms of volumes. So at the high end, obviously, for example, Titan has shown you that, you can still get reasonably good pricing, even though prices for their underlying products have gone up. Gold prices suddenly shot up. Despite that and a slight slowdown as a consequence, they've still reported decent numbers. So the consumer has been reasonably good has been reasonably active in the urban area. You're now looking for the rural parts to join in, and therefore I would think that consumer space, at least in terms of staples and the necessities, will at least be a market performer, if not marginally better.
So, I mean, as a strategy, Anand, what is it that you're doing right now? Advising people to put money or take it off the table?
Well, I don't think there is a need to be very aggressive in the market right now. It's not as if you are likely to get a runaway rally. But if your asset allocation is adequate and you are invested, then you should stay there. If you are over invested in equities, maybe you want to take a little bit off, but you have to remember that that's more to take care of the risk and allocation rather than in terms of a commentary on where the market direction is. I think the market direction will remain kind of in a range, but with an upward bias. You may see, as you mentioned, new highs as well. It's not likely to be an explosive run, though, in one direction.
And what do you think is going to lead us forward from here, Anand?
Well, I mean, as I mentioned, the biggest weight in the index and in terms of performance is likely to be the financials. So whether it is banks, the NBFCs, or any other, other intermediaries in the market, they are all doing reasonably well, and one expects that at least the asset lending side of the business will continue to do quite well. So most NBFCs and banks will, I think, report decent numbers. I would still think that you should be a little careful about the NBFCs, especially those which are completely wholesale and don't have retail deposits, because they can get into a little bit of trouble if the liquidity situation becomes tighter. But for now, almost everyone is on a good footing. Reliance, I think, again, now that they have also announced the demerger, should see a reasonably positive move. Most of their sectors are doing kind of okay. No particular reason to worry there. Most of the other areas are reasonably priced, so I think you have to be a little selective about where you put your money. The usual favorites of capital goods will show good numbers, but I think that they are slightly overpriced and therefore not much play left there. Auto and especially two-wheeler segment, I think may continue to show somewhat better numbers going forward.
Point taken. Let's bring on board our charters back to discuss their BTST ideas. Kunal, what is that you are strategizing for a buy today, sell tomorrow trade?
So two buy calls. The first one is about ONGC. The stock is actually trading with a negative bias, but I think it's hit back towards a key support base at 160 odd mark. So keeping 157 as a stop loss would suggest about ONGC more of a contrarian trade, target of 166 on the upside. Asian Paints is the other stock, and we were discussing this extensively over the last couple of days, that how crude has been forming a lot many bearish patterns. Now, if the patterns are here to be in play for the crude oil prices, I believe that sooner or later, many of these paint stocks could probably see a much more stronger rally. Betting on Asian Paints. Again, looking at the chart patterns, very aggressive kind of momentum seen today after quite some time. Targets of 3,300, stop loss at 2,800.
Nuresh, HDFC Bank is already trading at all-time high levels. You see further upside?
Yeah, so one of the picks for me is a buy on HDFC Bank, new all-time highs, a fresh breakout. It's a stock which could be a positional buy as well. So looking at a target price of 1750 and even higher, a stop loss at 1700. Second is a buy on Container Corp, which has given a 3 to 4 month range breakout, a stop loss at 624 and a target price of 650.
Okay, just looking at some of the other buzzers, M&M Finance, ABB, LIC Housing, Chola Finance, of course, has been a very strong one from the word go as we speak right now. Adani Enterprises, Bajaj Finance, Bajaj Finserv, HDFC Bank, like Anisha highlighted, HDFC after its numbers, and then SBI as well, which is scaling higher by 1.6% as we speak. There's also Reliance holding up 1% and Tata Steel as well, which is looking good. The other pocket, of course, which has also been holding out well is the entire crude sensitives. Given the dip that you've seen in crude, everything from paints to tires, which have a high crude component as their raw material costs, that's the one which is actually holding up. Adani Enterprises numbers as well, by the way, on your screens, and it's almost doubled their PAT in the fourth quarter alone. 722 crores is what they've reported as opposed to a comparable of 304, and that's on a year-on-year basis. That is the same quarter previous year, they had 304 crore rupees. So from that, it's a big beat. I just flagged off Adani Enterprises. It is your biggest large cap mover today. Stock holding up 4.5% as we speak right now. We'll await more numbers from there. But Anand, any near-term play on the crude sensitives, paints, tires?
Well, those are highly cyclical elements, and it's more a trade than an investment. So I can't really comment on it. You have to find your own space. Broadly, I think paints, etc., still remains highly expensive in terms of valuations, and also reasonably competitive going forward. So if you have to look at incentives, plays on basis of crude easing, you're probably better off looking at some of the chemicals and so on.
Okay, so those are the top bets coming in as far as the market is concerned. But we let you go on that note, Anand. Thank you so much for making time and speaking with us.